if that importer was normally importing goods that cost $100, and suddenly they have to pay $245 for that same $100 goods, and they're carrying that cost of capital, the cost of the inventory for 3 months, suddenly that group is like, where am I come up with the extra capital? That's a huge increase in the working capital that they need to carry for 90 days.
Sure.
And so that's a concern on that front of how do they finance the inventory even over that time period. And so we've seen some groups have a big increase. There's a huge increase in volume of capital needs right now because of that. They're still able to pass through prices. They're still able to maintain the profit margins, but they need a lot more capital in the interim just to make sure the trade finance happens.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC-registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to episode number 24 with the Bull of Wall Street. We are super happy to have JB Hayes and Curt Fintel with Variant joining us today. So welcome, guys.
Thanks, Jim. Excited to be here.
And you guys, remind me, you're in the Portland area?
We are, yeah. Firm is based here in Portland. Most of the firm is here. We do have a few people remote, but a majority of the team works out of Portland, Oregon.
Very, very good. Very good. Well, I'm flying solo today, but I love it still. Our CEO is usually with us. He's traveling. He's in between destinations, and a couple other hosts that we have. They're also got other things going on, but we're super, super happy to have you guys. So I met you, JP, when was it? A couple months ago in
March.
Frisco?
Yep. Yeah.
And I've been talking to Ryan. Ryan's been working with you guys, I think, for a while. That's been a number of years. And so I feel like you guys have got like one of the best kept strategies out there, but it's kind of secret. Not a lot of people know about it, which is great for investors. You don't want too much money coming in. But maybe you want a little bit more money coming in. So if maybe both of you, if you can just, you've been working together for a long time, right? So tell us the journey, and you can go back and forth however you want to do it. But how did you meet? How did you work together? How did you decide upon the strategy, and kind of take us from the past to present?
Sure. I'll kick it off, Curt, before I jump in. So we have been working together a long time. We joke often that we've been sitting next to each other for about 20 years, not only working together, but sitting office to office for a very long time.
Oh, wow.
So we met initially at our prior firm, which at the time was called CTC Consulting. Curt had been there for around 5 years when I joined in 2001. And so I joined shortly after college, after spending some time at Merrill Lynch, really kind of in the entry-level position there at CTC, but very quickly recognized that alternative investments were an area of interest for me. Curt was already in that space when I joined, and I happened to be placed in the office that was across from Curt. And so I was able to start chatting with him about alternative investments many years ago. Fast forward about 7 or 8 years, and I was then put in charge of ultimately of the private investments at CTC, which included these niche esoteric opportunities that we're looking at. And at the same time, Curt was chief investment strategist, and our third co-founder, Bob Elsasser, was head of fixed income. And so that's where the three of us were all working together at CTC. And I think one of the unique things about where we were at CTC was that we had the opportunity to go out and find best ideas. We weren't forced to just go after biggest names. Kind of, Jim, what you were just referencing in terms of secret or not as well known. You often find some great opportunities in those spaces. And it takes longer to diligence the idea and ultimately get it across the finish line. but we kept coming across these really unique investments. A lot of times they all shared kind of similar characteristics. Oftentimes had lower correlation to traditional markets, had a heavy income component to it, and just very unique. We felt like you got outsized return for the given level of risk. And so we were executing on those investments while at CTC. During that period of time, really took a step back and thought, this really makes sense to be in a broader universe of portfolios. CTC was working with ultra high net worth families, kind of institutional investment model. And at the same time, we were familiar with the interval fund structure and thought that was a very elegant structure to put these assets in. They're cash flowing, again, largely uncorrelated with the markets. And we thought it made a lot of sense to take this and package all these investments into one pool as opposed to doing things on a one-by-one basis and offer that to the broad market. And that's really how we got to coming with the idea of Variant, ultimately launching it in September of 2016. So coming up on 9 years now.
Wow. Well, good for you guys. And I mean, I guess if you've been working together for 20 years and you still like each other, then this is, you want to keep going, right? You want to see how far you can take it. And so you're two of the co-founders for Variant. And I think you're both CFA charter holders. So, fixed income, all of these fundamental things, but it's just different. I mean, not knocking any of the traditional fixed income, or even there's been a lot of money that's gone into just kind of this private credit. And I think when most people think of private credit, they're not thinking about what you guys are doing. They're thinking about middle market lending, bank loan type of investments. But you guys are totally different. You say niche, right? I mean, that's kind of your ticker, right? I'm not going to say it out loud, but like that's part of what you're doing is very niche. So maybe before I ask you to explain it, I'm going to ask Sarah. Sarah, by the way, she's our producer, but she's my daughter and she keeps me in line. But Sarah, if you can bring up the chart. I just have a chart here from Bloomberg, and for those that are listening, I'll try to explain it. But some people watch this on YouTube, and they can see that. So maybe make that a little bit bigger. So this is pretty incredible, right? I mean, this is almost a straight line. So in addition to a CFA charter holder, I'm also CMT, so I love charts. I love to geek out looking at different types of charts and support and Fibonacci and like, is it getting better? Is it getting worse? But like, this is like one of those few charts that I look at. I'm like, wow, it's just almost the straight line. There's a little bit going on, it looks like, in 2020, but you guys didn't really have any drawdowns. The green line here, just describing, we have the Barclays U.S. aggregate bond, quite a bit of volatility, especially in 2022, 2023. And shoot, now there's a lot of volatility. High yield bonds are on here, and then your strategy is on here. And it's looks like a straight line, but it looks like in 2024, there was a little bit of a stair step down, but then right back to the straight line. So tell me about this. Why is it so smooth? I know you guys are interval. And so for those that aren't familiar with that, you guys have a daily NAV, you have a daily buy, but investors can only get out once a quarter, subject to a potential gate. I don't know if you guys have gated before. Maybe you can comment on that, but like walk us through this a little bit.
Yeah, I can start with the high-level strategy. So I think that, yeah, you're right. There's lots of different variations of private credit, and lower middle market direct lending is where a lot of the assets are. But there's also a lot of opportunities when you think about investments that are below 100 million or even below $75 million deal size. And so for us, when you lend a $30 or $40 million revolving credit facility, at that size, we're able to charge much higher interest rates. And so they tend to be 13, 14, 15% yields. And that interest rate, the relatively short duration, so think about these as being 2 or 3 year loans, So you don't see a lot of the underlying duration you get from treasuries or high yield spreads, things like that. It's short duration, high yielding already. And so it tends to be its own market. And so you don't see it track equities that much. You don't see it track core fixed income or spreads because it's really its own segment. Even in periods of heightened volatility, we're still doing deals in the mid-teens. Interest rates over this time period, right? Interest rates have gone down to zero. They've been up to, over 5%, and we've seen the 10-year treasuries all over the place. But we keep originating and servicing loans in a very narrow interest rate band in the low to mid-teens. And that really helps to mitigate the volatility.
That's incredible. Well, and you're doing different things too. Oh, I'm sorry. Go ahead.
I'm happy to speak a little bit more about what that investment strategy is, if you'd like, or we can save that for another page.
Yeah, Sarah, you can put away the chart. So, yeah, I guess I'm just curious. Like you're doing a lot of different things here. I see in the portfolio. This strategy you've got, and you've got other strategies too, right? So you can feel free to talk about the other strategies, but litigation finance kind of sticks out. I mean, that's kind of interesting. Like, what is that? I mean, I read it and I've read it multiple times, but like, I feel like I need to be reminded. And then you got specialty finance, cash, real estate, all of those seem kind of normal. Trade finance, I'm curious about that, especially with all of the talk of tariffs and like this is, finance for like a container shipping things, right? So maybe you can speak to the litigation finance, the specialty finance, and the trade finance. What are those and why do they work? And by the way, is this something that you've seen other firms get into? Because I feel like the large bond managers, I'm not going to name any names here, but these are probably just too small for them to get into. Is that right?
Yeah, I mean, that's a great point, and that's something that really is a focus for us as we target our investments and sizing. Curt was referencing that $75 million and below. So I think from a deal size, but then just an asset class perspective, right? Some of these asset classes can't really take in or absorb too much capital. And again, that creates these really interesting sleeves for us. Hitting on some of the names or sleeves that you referenced there. So I'll tackle litigation finance. So this is an interesting space. It's been around for a few years here in the U.S. and in Europe. It was a little ahead of us on that front. But what you typically see within litigation finance, what a lot of investors do, is they fund effectively cases, right, where they take somewhat of a bet on an outcome of a case, and you can get a very nice return from that, but it's very binary in nature. And for us, as a credit fund, that's not how we wanted to invest. And again, not that that's a bad way, just not a fit for what we wanted to do in our fund. So what we initially focus on primarily within litigation finance is what we call law firm lending. And that's where we'll partner with someone who will provide a loan to a law firm that's secured by all their cases. And this could be a group that's focused on personal injury or could have mass tort or any of those underlying types of exposures. And so they'll provide them a loan secured by all of those cases. And as those cases settle over time or go to trial, the fees that the lawyers would receive, that's coming back as payment to us, right? And so it's a really interesting opportunity. A lot of those are contingency fee cases, right? And so these law firms need to manage or operate their business, right? They've got lease and salary and all that they have to pay. And so this loan comes in, provides them that capital, and lets them operate their business and grow their business. And again, they're constantly bringing on new collateral. So it's a really interesting exposure because of that diversification of collateral, that very low LTV that you're getting that exposure at, and then that collateral is constantly being added to as they bring on more and more cases in whatever their given focus area is.
Wow. And so what's the risk? Like if they don't win the case and it's short-term lending, right? So this is not ongoing, but maybe you probably work with the same law firms doing this.
Yeah, so they do. This tends to be kind of our longer duration exposure in the portfolio, typically because there's some unknown around the timing of the settlements, and things like personal injury could be shorter, things like mass tort could be longer, right on the spectrum. And so, these tend to have a little bit longer duration. on the underlying exposure. The risks, you could have a lot of the cases go poorly or not settle. Those tend to be, kind of one-off events. You've got some operational risk, if you will, at the underlying law firm. If you had a lot of the lawyers leave and things like that, tracking down the collateral could be challenging. But I think the biggest risk that we focus on, and part of why we've shifted our strategy a little bit over time, is really just the length of some of these cases. In particular, if you think about mass tort that may go on, and they may fight it, and you're talking about large counterparties that have the ability to do that. And when you come into the low LTV, and if you're all tied to one outcome of a certain type of mass tort case, that low LTV gets eaten away quickly, right? As that interest picks. And so really duration is a big concern for us. And so if you look at how we've, I think as you adjust your portfolio over time, right, as you keep building out your exposures, you have lessons that you learn. And I think one for us has just been less mass tort exposure. It doesn't mean zero. It doesn't always mean bad. But for us, I think those things like personal injury that have typically a much shorter duration, are more attractive for a fund structure like we have versus maybe something else that could take that long-term illiquidity in mass tort. And so that's one of the risks there, is just that duration of the underlying cases.
Interesting. And then do you just I'm curious, how you find these law firms. Are they like kind of in your backyard, or are they like nationwide? And do you is there a pool? I don't know if you just call them up and say, hey, do you need some money, and we'll finance you. How does that work?
Yeah. I mean, so we're always working with a partner who's got that domain expertise, right? They've been doing this for a long time. We're providing them a loan to go out and execute their strategy. So they're the ones that will be sourcing the underlying deals.
Oh, God.
So the underlying
Okay.
deals, it's a relationship game, just like anything in the sourcing. There are brokers out there working with these law firms looking for this lending, conferences that these groups attend. And so they're sourcing that. I mean, for us, we certainly want to be diversified geographically, right? We don't want to just have law firms that are in the Northwest, for example. So a lot of our exposure, our exposure is spread out through the U.S. We want to have diversification by type of collateral, not just, I referenced personal injury, but not just personal injury. We want to have other exposures there. We've got patent in the portfolio, patent finance in the portfolio. We've got
interesting.
Personal advances. We've got other flavors within litigation finance, because just like you were saying earlier on private credit, which is such an important thing to highlight, that people think of middle market direct lending as private credit. It is a big piece of it, but there's other sleeves of private credit. We obviously sit in one of those other sleeves within the asset-based lending space. It's the same thing with litigation finance, right? I think people think of maybe one area, but there are a lot of different verticals within litigation finance, and we want to make sure we're diversified across all of those as we build out the portfolio.
That's super interesting. And then with specialty, what's specialty finance? Tell me about that one. And you got some other interesting things. Some of these, like I said, kind of get real estate debt, I think is fairly straightforward, or real estate equity. But maybe you can talk to this the trade finance, the specialty finance, royalties.
Yeah, there's a lot of interesting things in there. So let's start with specialty finance. So specialty finance is a very broad asset class, and at the highest level, what we're doing is we're providing capital to another lender. So we're basically a lender to another lender. It could be a small business, consumer lending. It could be lots of different underlying types of things that they're lending to. But we are providing capital to a group that has expertise in a particular vertical. So let's say an example is small business lending. So there might be a group that raises $10 million from a VC. It's like a fintech place. So it's a fintech-based venture capital fund. They provide $10 million to this group. $5 million is the operating money that helps them keep the lights on, pay rent, pay salaries. And the other $5 million goes to a lending book. And so they start lending to small businesses. So these are small loans, like $50,000, $100,000 loans.
Oh, interesting.
Businesses. Okay. And so the whole reason why this exists is that if you were a small business and you want a $20,000 loan, good luck going to Bank of America or Wells Fargo or your local bank in the corner and getting a $20,000 small business loan.
Sure.
What do those banks know? They know autos, they know credit cards, they know housing. But when you get to a small business, it's much more difficult for them to underwrite it. So Bank of America wants those really commodity type things, or they want to make a $500 million loan to a commercial business, right? That goes to a different team.
Got it.
A
Yeah.
$20,000 small business loan, they just look at that and like, yeah, we really can't help you. So that's where the whole concept of online lending, these fintech lenders emerges, is they fill that role that bricks and mortar banks can't play or won't play. And so this lender, going back to my example, 10 million from a VC fund, 5 goes to operating capital, 5 goes to a loan book. They take that $5 million, they start lending to these small businesses. They develop a track record, they hone their models, and eventually they get to the point where they need another lender to build out their balance sheet of lending. So we take their $5 million of capital and we give them a $20 million loan, so they have $25 million in total to lend. But the trick is that $5 million of coming from the VC is a first loss position. So if one of those small business loans goes bad, that originator, that lender needs to buy that loan away from us and replace it with a good loan. So that absorbs any losses if there are in the portfolio. And that's a huge difference between that type of lending, specialty finance lending. So the specialty finance lender is that small business lender. Behind the scenes, we're providing capital to them. And there's hundreds or thousands of underlying loans in those portfolios. That's very different than middle market direct lending, where you're lending to one business and one operating model. And so you can imagine, it's bigger companies, but they will go under, and there's no extra capital there to support it. If the private equity sponsor says, we can't support it anymore, you've lost that capital in that one investment. In specialty finance, it's diversified across hundreds or thousands of underlying loans. So that's when we say specialty finance, that we're thinking of you can repeat that model in other types of lending, like equipment finance or consumer finance, but it all is that same lender to a lender model.
Wow. There's got a lot going on. You really have a lot going on. But just looking at the low risk and the return, you're doing an amazing job. However you're building this and mitigating it. Now there was that little dip in 2024. What happened there?
Yeah, that's, we normally describe this strategy as being drama free, but there's a lot of drama, a year ago in that blip. Yeah. So that really comes back to, a lot of what we do is lending. Our main strategy has the ability to take some equity investments. And so this was a legacy investment, a legacy equity investment from one of our early days.
Oh,
and then
interesting.
Equities, it has a different risk profile. And you certainly saw that show up in that blip. But that's really, today we do very little of that type of investing.
And so so when you see that the value goes down, you can write it down, but then you can also write it back up too, right? If there's some recovery.
Right. Yeah,
that's interesting. Right. Now, how about the trade finance? Does that change at all with tariffs? And like I saw a report that like the number of containers that are being shipped from China has just gone down by a huge margin. Yeah. There's
so many interesting sub stories attached to that. So starting off, trade finance is one that we get into very selectively. It's not an asset class we always like. In the good years, it's very bankable. The rates are pretty low, and the stuff that's not bankable tends to be higher risk. So we don't do a lot of that. But there are periods of times where it's quite interesting. And now it's kind of one of those because you have a lot of sub-themes going on there, one of which is just businesses. Well, obviously, we all know about the uncertainty, right? You don't know, do we import goods now under the current tariff regime? What's it going to be in 2 weeks? Is it going to be higher? Is it going to be lower? Right? And getting caught sort of midstream on, I paid, $100 for goods that's tomorrow going to be worth $50 because there was a 2x tariff in place today, and then in 2 weeks from now it's gone, right? That can really dramatically impact the profit margins and even the going concern of these groups. So that's kind of one concern. Another concern is, let's say that you've matched up a buyer of the goods, and they're saying, I need this. I'm willing to pay whatever tariff comes in. Just give me a fair shake. If the tariff is X, I will pay it. But you still have the problem of if that importer was normally importing goods that cost $100, and suddenly they have to pay $245 for that same $100 goods, and they're carrying that cost of capital, the cost of the inventory for 3 months. Something that group is like, where am I come up with the extra capital? that's a huge increase in the working capital that they need to carry for 90 days.
Sure.
And so that's a concern on that front of how do they finance the inventory even over that time period. And so we've seen some groups have a big increase. There's a huge increase in volume of capital needs right now because of that. They're still able to pass through prices. They're still able to maintain the profit margins, but they need a lot more capital in the interim just to make sure the trade finance happens.
Wow.
So that's one sub-theme. And then you have, there's this whole question of what do you do? You can imagine these groups have a war board going up of particularly China imports. Like, do we import it now and then try and pass the cost on? Do we wait 2 weeks, do we wait 4 weeks, wait 6 weeks for things to get cheaper? How low can we go on our inventories before we have to order from China? There's just not enough capacity elsewhere in the world to make up for all of the potential production in China. And so everyone's going through this example of these scenarios of when do we import and how much. And as you referenced, Jim, the amount of containers has dropped, right? There's a surge as people were trying to get before tariffs. Now that tariffs are in effect, there's a big drop of that, and people are waiting. The problem is not everyone can wait altogether, right? Somebody has to buy now, because if everyone, let's say that this goes on for 45 days and Trump says, okay, we're going back to normal tariffs, right? Biden-era tariffs. What's going to happen? Everyone's going to put their orders in at the same time. Everyone's going to want the same slot of production from the factory, and everyone's going to want to book a container ship at the same time. It's basically a recreation of the supply chain finance problems we saw a couple of years ago, where cargo ships were just stacked off of LA, right, ready to come in because they couldn't take all of that. COVID had the drop, and then the post-COVID was this huge surge in demand. We could see that the longer these tariffs last, the more likely we're going to see another supply chain issue where it's all jammed up and we're unable to bring things in because you just can't stop importing for 45 days, 60 days, and then expect to resume like normal. So we're watching that. It's our trade finance is very targeted, very focused, but there's definitely a lot of context going on of how people are trying to time the system and time the tariffs.
Sounds kind of like a logistical mess.
Yeah, for sure.
Hopefully we don't have any issues with toilet paper and hand sanitizer. I think at one point was like $80 for like a small bottle. Yeah. Well, that was COVID related, but yeah, it's wild. Interesting. And then royalties. So is this like old music royalties that or like movies? Explain what that one is.
Yeah. So when we think royalties, we have a pretty wide band on what we're looking at. It could be anything from healthcare royalties to music, to film, to oil and gas, right? We have a very wide spectrum in terms of what we're thinking about. So what we find attractive, at least today, music royalties has been very interesting. So if you dial back to the day we launched our fund, October 1st of 2017, the first investment we did is we partnered with a group in New York to buy Elvis Presley's music royalties, right? And so very interesting opportunity, because our idea at the time was, there was a growth to streaming, which I think is certainly played out. So you're going to see an increase in these royalty payments. And there's an opportunity really in these payments. If you look at them historically, they really don't move at all with the market, right? People are still listening to music. People are still paying for music through all up and down cycles. So we felt like this was really interesting, that it wouldn't necessarily correlate with the markets at all. It was very consistent. If you think about royalties, they're the life of the artist plus 70 years. So these assets have a very, very long life.
Oh, wow.
And you can kind of underwrite these assets post their initial release. A few years later, those revenues stay very, very consistent for a long period of time. And so that was our first investment. We did a couple investments of buying royalties. Over time, we saw more and more capital flooding in. I mean, people have seen the headlines of the artists that have sold their royalties over the last few years. It really became more common coming out of COVID, when these musicians weren't playing in concerts anymore and things like that. And so they recognized the opportunity to sell their royalties at these large numbers. And so we saw the price paid for these going up significantly, and it didn't make sense for us any longer to necessarily be active in purchasing royalties. But so we shifted a little bit to lending against these. And so we have an investment today that's really interesting, where they lend to lesser known artists, but it's more of their mature music catalog, right? These songs have been out for 3 or 4 years. This isn't a new release. They can underwrite those songs. They have a really good idea of what that revenue is going to be like over the next 3 or 4 years, and they'll lend against that. And so it's good for the artist because they get some upfront capital, which is what they're looking for, maybe to produce their next album. And they retain ownership of their music royalty rights, which is great. And for us and our partner, we're lending against very stable streams of capital coming in on these royalties. Fairly easy for this group to model out what they're expected to get. And then, to Curt's point earlier, our partner's putting in first loss capital. So you've got hundreds and hundreds of underlying artists in here, very diversified royalty stream, and I think historically a very low loss rate. And then if anything does go sideways, you've got our partner's first loss capital. So that's been interesting for us. In the film side, we are, to be clear, we are not lending on hoping a movie is good. I think lending on gate
Okay.
it can be challenging, right? So we're lending against, maybe tax incentives coming from local jurisdictions for a movie being produced there. We're lending against pre-sold distribution rights. If someone wants to distribute a movie in Germany, they have to put in some capital up front. We're lending against that. That's what's interesting to us, right? It's not whether the movie is good or bad. It just has to be completed, and then those are unlocked, and you can get your collateral recovery. And so, we'll have things like have our partner put in a completion bond insurance program to make sure these cost overruns, if there are cost overruns, are covered to make sure that film gets completed. So that's been a very interesting space for us, diversified across a lot of underlying films, some of which are out, some of which are coming out. We have another facility in that space that's what we're nearing completion on. So I think it's a really interesting opportunity for us. And then you go to the far other end of oil and gas, right? And this is lending against producing assets where the oil is coming out of the ground. These are operating. It's in place, and so effectively you've got this consistent stream of royalty or cash coming off of these operating assets. Oftentimes they're looking for that capital to maybe go do additional drilling or what have you. And so we partner with a group that comes in and lends at quite low LTVs, but then we also have them hedge out the commodity, right? We don't want to take that risk of going up and down. We see it today. I think it's last week it was in the low 60s, right? But we've seen that move down. But over time, we've seen it go way up to in COVID when it was,
and it was negative too for a while, right?
It was negative, right? Exactly.
That's wild.
And so we've seen that, and we've been able to manage through those periods because of how these underlying deals are structured, right? You're not taking drilling risk. You're not hoping you hit on the next well. These are just producing exposures, relatively short duration assets. Again, for us, right? We look at things less than 3 years. So we're not trying to lend against this well for 10 years. And so, very interesting, obviously completely different than music and film. It all sits in our royalty bucket, but it's a space we spent a lot of time in. In our prior lives, we were very active in the healthcare royalty space. And while we don't find that compelling yet today, we continue to monitor it, and you could go. And that's where you're kind of providing capital against, the future release of drugs and the like. So that's a space that we've been active in our prior lives. We could come back around. So it's a very wide funnel, right? And that's how we operate and why we think it can be interesting to package that into one fund.
Sounds like you guys are really, really great at finding a lot of different interesting areas, but just investing a little bit in each, so I feel like the diversification is really, really great, so that if something doesn't work out, you can move out of that one, move into other areas. I have to ask, because I'm actually speaking at a conference in Nashville next week. And so for the music deals, hopefully you can get a little bit of equity in case you might discover the next Taylor Swift, right? Then that can add to the portfolio returns.
That's right. That is what we think about there. You selectively, because you look at those opportunities, but I think for our investors are looking for that downside protection, and so the lending against it is pretty interesting for us.
Lending's a little bit easier way of doing it.
That's right.
No boom or bust. But so I have to ask, so when people listen to Beatles or like to Elvis, do you get like a little tiny bit of, money when people listen to that?
Yep, effectively, and we always laugh because our first holiday card we sent out years and years ago had a link to all of Elvis's songs, hoping people would just listen a few more times.
I love it. I love it. That's amazing. So I have to ask, with all the different things you're doing, and I love it because it's just different than traditional fixed income. Not that there's anything wrong with high yield bonds or regular, bonds, credit or treasury bonds. In the past, I've, worked in areas where we invested in things like this. And we also invested in, these bonds that would benefit from, disasters or climate change. You like the quota shares and the cat bonds. I've moved away from that just because I feel like with global warming or climate change, whatever you may call it, it's just not the same. It's not the same investment. Do you guys ever look at some of the pieces within your portfolio or your strategies and say, well, because things are changing, maybe this changes and maybe it's not something like, and I don't know how politics plays in, you've got one administration comes in and they want to have a lot of regulations, and another one says we want to remove those. So how do you navigate all of this? And by the way, are there areas that are newer that might be related to technology or AI or data factories that you might say, hey, that looks kind of interesting. It's a newer type of investment. Just curious.
Sure. Yeah, I can start and Curt jump in. So, I think, look, one thing that we wanted when we started the firm was to not have a minimum amount into any of our underlying asset classes. We felt that having that kind of agnostic approach to really finding what we thought was most interesting and attractive at that time made a lot of sense. And so if you look at our asset classes over time, then we have a chart. It shows exposures increasing and decreasing. It's been on, and sometimes it's at zero.
Sure.
We always say we move more like an ocean liner than a speedboat, right? These are illiquid and they wind down over time, so you can't sell something tomorrow. But we want to make sure we're reflecting what we think are best ideas in our portfolio as we build it out. And one asset class, we certainly know the reinsurance space well. We haven't had any exposure in that market, but another market that I would just hit on, just kind of, I think, exhibit something that you're hitting on, which is life settlements. Life settlements was a space that we had looked at since the early aughts, and so I think we know that space fairly well. We keep up the speed up on that space, and so look, I think at a high level, it's very interesting, right? It's certainly not necessarily lending, but when you have a portfolio of a certain amount of policies, it's very fixed income like, right? And so in theory, it would, and it's obviously uncorrelated with the equity and fixed income markets. So it can be a nice add to a portfolio for someone like us who's building out this diversified pool. The challenge is, and so we made an investment early on in our days at Variant and in the life settlement space. The challenge for us, or what we saw happening, was a significant amount of capital flooding into that marketplace. Right? Groups have been very successful at raising capital, and so what you saw was, there's only a certain amount of policies that are sold on any given year in the primary market, and so what you ultimately saw, or what we felt like we were seeing, were shops or investment firms selling policies effectively to each other, and it's starting to compress in terms of what kind of return you can get in that. And so we saw an asset class that has been more of a 12 to 15% return, stepping down. And our view, this is back in kind of late 2018, early 2019, was that there was going to be more and more capital flooding that marketplace. And at some point, that return just wasn't going to be attractive. And so we decided to wind down that position. We continue to monitor that position. We have looked at opportunities to lend against those exposures. We haven't ever closed a deal there, but we've looked at those opportunities. But I will sit here and say that I feel really good about that ultimate decision, right? Those returns have continued to come down. And again, it's not that the asset class is bad. It just doesn't make sense for our portfolio, given the amount of capital that's flooded into that market, to really compress returns, and just made sense for us to focus.
Yeah.
We see so many different opportunities, made sense for us to focus in other areas. So that's one that we've seen kind of, hey, really interesting and fade down. I don't know, Curt, if you had any others or any newer asset classes you wanted to highlight.
Mm-hmm. Well, Jim had mentioned AI, so I was going to talk a little bit about what we're doing there. So AI, yeah, obviously there's a tremendous amount of interest in that, a lot of capital flowing into that. We haven't done a lot of lending on what we call the software side of this. Part of that is people are trying to figure out how to monetize all the AI investments that they put in, right? All of it's given away for free or a very small dollar amount. So you still need to kind of reckon all the expenditures and generate the revenue on the other side of this and hopefully profits. But our play has been less on the software side, more on the hardware side. So there's a tremendous amount of interest in leasing data centers to compute the models, either in the model itself or computing in real time when somebody puts a prompt in. That requires NVIDIA is by far the largest supplier of the GPUs that are doing the processing for all the AI on the back end. There's tremendous capital need. Those processors are very expensive. And so we've taken the equipment finance side of this, where we're providing capital to the data centers that are buying these chips, putting them in these data centers, and then leasing them out to people running the models. And so that payback period is pretty short for us, like 2 years, and the demand is very high. So for us, about a year ago, we made the first investment there. So we got most of our money back already from that.
Wow.
But that would be a play. It's time and specific, right? Because those chips will come down in price. They'll become more efficient over time. But right now, there's just a huge demand for that hardware.
Mm-hmm. It's interesting when you were talking about JB about all the money coming in. For whatever reason, I just thought of reverse mortgages and Eric Estrada and all these people that are like trying to, or is it Tom Selleck? I don't remember, like, you know what I mean? All the TV ads and like, do your reverse mortgage. And then I think Eric Estrada might have been like timeshares out somewhere. But that's interesting. So when you talk about capital flows, I mean, I guess if everyone just discovered Variant, you guys do have the ability. You've done it before. You can close the fund to say, hey, we don't want that much capital coming in here. Is that something you continue to look at with flows, and do other people start entering the space? Do other larger private equity or private credit folks start getting into there? And does the market get bigger? Does it stay about the same? What do you think?
Yeah. No, it's interesting. I always like telling the story. When we were just starting out, we were $30 million and working hard to get on one of the platforms where people could access the fund. And so we talked to them, and finally we got the green light that we were going to be on the platform. And literally on the first call after that with the onboarding team, we said, okay, what's the path if we want to close the fund? And their comment back was, well, maybe you should raise some capital first before you think about closing the fund, which was totally fair. But I think it speaks to our mindset, right, in terms of how we wanted to build the product.
Sure.
Because these are not things where we can add a zero to and make a trade ticket, right? These are all illiquid, highly structured deals that we're building out. And so for us, we've wanted to really try to grow this in more of a programmatic approach in terms of the amount of capital coming in on a monthly or quarterly basis. That's really what we focus on, and over time. And you referenced this. There have been multiple times in our fund's history where we've put effectively a soft close in place to not allow new investors in. And look, those are tough decisions to make, but we at the end of the day are trying to generate the best return for our investors, do the right thing for our current investors in the fund. And at times when too much capital is coming into our fund specifically, that makes it really difficult to deploy. And we don't want to ever get in that position where you feel like you're stretching to do a deal just to deploy capital, right? Because at the end of the day, those are the deals that you're going to be working out 2 or 3 years later, more than likely, because you were justifying something. So that's a really important thing and something we've done. Now, when we did start out, kind of going back to that time, there weren't a lot of asset-based lenders, certainly in the interval fund space. There were some in the private lending or private credit space in general, but in the interval fund market, it was pretty nascent. We've seen that evolve over time, right? There are more groups coming into the marketplace with at least some sleeve of asset-based lending there. I think we've also seen some of the larger names that everyone here is probably familiar with move into the space as well. And so that does present a little bit of a different dynamic for us. I will say, I believe our kind of calling card or unique feature within our structure is the size of deals that we go after, right? When you're looking at, if you're a larger firm and you're coming into the marketplace, you don't want to write and do the work on a deal that's less than $100 million. It just doesn't make sense.
Yeah.
Right? Yeah. They not only have their interval fund, they've got their private fund, they've got SMAs, they've got other relationships, and they need to allocate this deal across all of those and make it make sense. Right. And I get it. Right. If you are that large, it does not make sense to do probably 150 to $200 million deal. We have said since we started growing and really kind of past 750 to $1 billion fund size, that we were going to focus on those 20 to $50 million deals. Now, those can grow over time. Maybe they get to 75, 100, $125 million, and that can be attractive. But we want to enter in those deals in that 15 to $25 million space initially. And I think that is a differentiating factor within the asset-based lending space. We, again, feel like you can get better returns for the given level of risk because there are fewer players in that marketplace, and then you grow those over time. So I think that gives us some, I won't say protection, but means the competition is a little bit less than in those $100 to $200 million deals where there are a lot of groups competing because they just have to allocate those deals across multiple sleeves.
Do you think over time there's more capital that goes into some of these niche areas or not so much?
I think so. I think more, people are recognizing this as an opportunity. They're allocating dollars there. I think there are going to be more asset classes that we're not even thinking about today that probably grow and taking capital. I think some of these other asset classes or opportunities, they didn't recognize they could get this capital and start looking for it. So I think there's room to run on both fronts, right? More groups coming in to provide that capital, but also more capital need from the underlying borrowers in these eclectic markets because it's just becoming more understood that this capital is available to them today.
We generally call what we're doing Main Street finance versus Wall Street financing. And that category of Main Street is huge, right? When you think about just the large swath of the economy, that's small and medium-sized businesses. And it's not, we do things outside the U.S. too. We'll do developed markets, some in the EM, Mexico. That's just a lot of capital needs. So in some respects, there's room for a lot of groups to provide capital here for a long period of time.
And remind me, you guys are mostly just the U.S. though. You don't go outside the U.S. or do you a little bit?
Yeah, we can certainly look at. We've done deals in Canada and in UK, Australia.
Okay.
So, we'll certainly look abroad. Sometimes countries that are used to a higher interest rate, our model of especially finance to a lender to another lender structure actually works better in countries that are used to a higher interest rate, and they can actually adapt to that model better than some U.S. fintech lending can.
Interesting.
We will hedge the currency though, or have them hedge it. So we're not trying to take currency risk here. Yeah. And as you pointed out, the majority of the portfolio is U.S. based, but there are really compelling opportunities for us in some non-U.S. Jurisdictions, and we've got partners who are based there, right? Boots on the ground. They know the space very well, and are finding some interesting opportunities. So we will do that as well.
So I feel like with all the different things you're doing with trade finance, maybe not so much the litigation finance, but small businesses, I feel like you guys might have a pretty good pulse on kind of where the economy is going. I know you're not macro folks. We have our macro guy who normally be on here. He's doing some media things in New York City. But do you guys get a sense for like, hey, these certain areas are slowing more? Because I know we consume a lot of research and we listen to some of the big shops that talk about macro and a lot of people are calling for a recession but it feels like most of it is top down, not a lot of it's bottom up. I like to look at the bottom up as well just to see because consumers sometimes they say one thing, or businesses say one thing, but they do something different, right? There's the hard data versus the soft data. Do you guys get any indication in terms of what people are doing based on how they're lending?
Yeah, so obviously it varies upon what asset class and how tariff specific today, right? It's really tariff specific.
Sure.
That looks like. Obviously, there could be some net positive benefit here if the Fed takes rates lower or looks through potential inflation and actually lowers. In fact, if you looked at the forward curve on SOFR, it's actually come down quite a bit versus the beginning of the year, right? Because people are looking through that saying the Fed's going to be actually lowering rates to fight recession more so than inflation. And so that's a net positive.
Yeah.
But it really comes down to how close you are to the way tariff is impacting things. And there's, for any business that's even tangentially close to that, there's certainly a lot of stress there. We haven't seen that fully show up in the data. It takes a while for that to really mature through the whole process. And people talk about monetary policy, taking long and variable lags to show up in the data. Same thing is true with fiscal policy like this. It doesn't show up overnight. You start hearing stories turn into decisions, and eventually you see bankruptcies, delinquencies, demand going down, demand or destruction. It takes a while for that to happen. And it really, right now, we're all waiting to see how long tariffs will be in place, and what the next chapter looks like. If that chapter comes quickly and the tariff conversation closes quickly, then this is something that's pretty easy to mitigate and work through. If this carries on, though, if weeks draw into months, then the stress turns into real problems.
Oh, interesting. Do you guys usually pick up on that because of stress and, the lenders coming back to you or the borrowers coming back to you and saying, hey, I want to work this out. Let's do a workout. Or has it come in the lack of demand to borrow, or both?
Yeah, well, we're certainly saying no shortage of demand for capital today.
Okay.
Now, you could also argue that's a warning sign, right?
Yeah, that's
People
true.
are taking liquidity and they get it. For us, we have a lot of investments where we have more or less real-time tracking, right? We'll look at the loan performance of going back, especially the finance example, where you have hundreds of small business loans in a particular one of our facilities. So you've got, let's say, 300 small businesses. You're looking at how fast those small businesses are making their payments. And if one borrower goes from 10 days past due to 30 days past due, right, you start looking at that delinquency number. And that's where you really first see it, is when they start missing their payments. And we've seen a little uptick on that. It hasn't been a lot, but that's kind of the canary in the coal mine. That's what we're watching first to see if that really starts. If they start getting behind on payments, then you know that there's a whole wall of further problems down the road.
That's fascinating. But then you guys, I feel like you've built so much cushion into what you're doing that even if you have a few of them here and there that don't work out, you're diversified. And I mean, even last year when you took that little bit of a hit, you still ended up net positive, right? So
yeah, that's right.
Is that mainly just because the yield is so high in many cases?
Yeah, high yield, diversification, right? That all factors together. But for us, when we look at a new investment, we have no insight onto today we think tariffs might produce a recession, but in any given environment, we don't know what's going to bring the next recession. Each recession is unique, how it came about, how much the drawdown will be, how long it takes to recover. Each one's very unique in its own fingerprint. But we assume that we're going to have a recession on any investment we make, and so when we ask the equity sponsor, we look at that and we ask the equity sponsor to put in enough capital to survive a normal recession.
Oh yeah,
right. We're not going to be perfect. If there's a super deep, think GFC or something of that nature, not every investment is going to be unscathed, right? The music royalties, things like that are probably fine. Litigation finance is probably fine, but not every lending category is going to be fine with that level of recession. But we do assume that we're going to see a recession in the period of time that we make an investment.
So that's kind of like, it sounds like your margin of safety. You have to have that kind of buffer in place. Interesting. Well, this has been super interesting. Let me just see if I have got any other questions. Yeah, I think you answer all my questions. Oh, I guess the other question is like how should advisors use you guys, and where? I'm guessing they would take this from their traditional fixed income bucket. And I'm, by the way, I'm always telling advisors, like, just really, really understand you should not plan on taking this out, even though there is quarterly liquidity. Plan on not taking assets out. And then you just kind of talk to that. And then have you guys have you had to put up the gates at all? You've managed the flows, I think, pretty well.
Yeah. So hitting a couple things. So yes, specifically with the gates, we have had to put up the gates a few times. I think, it really speaks to the benefit of the fund structure in that, to your point, flows, both new investor flows have stayed very strong. Liquidity on the underlying portfolio from a principal and interest standpoint have remained very strong. And so we have credit facilities that we could use if we needed to for liquidity purposes at the fund level. We haven't used those at all. We haven't used any of our short-term notes for liquidity. We've got significant amount of capital to still allocate to new deals. And so I think that really speaks to the structure of the fund. And we do talk a lot about what the point you just hit, and it's really important to us, is that we want investors to view this as a long-term investment, right? Yes, there is liquidity option for investors, but we want you to understand what you're getting into. It may not be a fit for everyone, and that's absolutely okay, but we think it brings a lot of value into a client portfolio. In terms of how people are using it, it's a good question. I think a lot of people are doing exactly what you're saying, right? Taking it out of more of the traditional fixed income type exposure and allocating to private credit. And a lot of groups will do some into middle market direct lending and some into an asset-based lender like us. And that to us makes a lot of sense. I get why people do that, because it gets you that private credit exposure, but we're certainly going to behave very differently than a middle market or just a direct lender, right? They're going to have more economic sensitivity in that, probably leverage on that fund. Again, still can be very interesting. We're going to have a little bit less economic sensitivity just given the nature of our assets that we've discussed. We're unlevered. They're going to behave differently in markets. And so a lot of people are looking to do kind of a private credit, couple of investments in that, different types of underlying exposures in their portfolio. And we see more and more of the advisors rolling it out that way.
Come and dance on our floor. Take a step that is new.